guys, it's Dakota Wixom here from quantbros.com, and today we're going to talk about what beta is, why you need it, and how to calculate it. So to kick things off, beta is a way to measure the systematic risk of a particular security or how correlated price movements of that security are to price movements of the overall market or index. This means that a high beta coefficient suggests a high risk investment, and a low beta suggests a low risk investment. For example, a beta of 1 would mean that a security's return perfectly correlates with the market. If the market goes up 10%, so will this security. A beta over 1 means that a security will amplify the returns of the market, and a beta under 1 means that the returns of the market will only somewhat affect the returns of that security. This may be a little confusing, but for example, a stock with a beta of 2 will rise 20% if the market rises by only 10%. That's 2 times 10%, but it's also going to fall by 20% if the market falls by 10%. This is why high beta stocks are generally considered more risky. A low beta stock, say at 0.5, would only rise by 5% if the market rises by 10%, but it's also only going to fall by 5% if the market falls by 10%. This means that the return of that security would have more to do with the performance of that specific company or asset rather than the performance of the market as a whole. High beta assets tend to be in things like luxury goods or technology. Low beta assets tend to be in things that people always need. For example, utilities or commodities such as gold. The holy grail of investments would be finding multiple securities with betas close to 0. This means that the returns of those securities would be entirely uncorrelated with the market, which would potentially maximize the returns while also minimizing risk. That's what Ray Dalio is looking for. So there's multiple ways to calculate beta. It all depends on the method that you use, whether it be CAPM or regression, the metric you're using, such as the return or return on equity of an asset. It also depends on the metric that you're calculating, how you're calculating the metric. For example, if you're using closing returns, the returns on closing prices, or the adjusted close. It also depends on the granularity of the data, whether it be daily, weekly, or monthly returns, the time span, over 1 year, 3 years, or 5 years, and also the index, whether it be the S&P 500 or the NASDAQ, or whatever it may be. So we're going to look at Yahoo Finance here. We're going to see that the beta that they've calculated for Microsoft is 0.86. Now, if you're calculating beta on your own, it's going to be slightly different in most cases. We don't know what time span they use. We don't know what index they use. But as you'll see, when we go through this, when we calculate our own data, we can figure out exactly what they used. And it turns out that they use beta with daily prices over 5 years with the NASDAQ, not the S&P 500 as most people tend to use. And this makes sense because Microsoft is a tech company. So this is why you kind of have to be careful. Betas can be all over the place. It depends entirely on how you're calculating the beta, and if you want to use it, you want to be sure you know how the beta is calculated, or you can just calculate it yourself, which is why we're learning what we are today. So we're going to first download the historical prices. This is Microsoft, so we're going to probably use the NASDAQ. Beta is often calculated using the S&P 500 for some reason. A lot of people just like that. But I think that the NASDAQ might be better. And I've done this before, and it's been shown in my studies that the NASDAQ is actually a much better approximator of beta than the S&P 500 for Microsoft. So we're going to download the data here on Yahoo Finance. I've already done it, but if you don't know how to do it, you just go to historical prices, type in whatever the security is that you want. It could even be something like a gold index or oil index. You can download daily, weekly, or monthly. For our example, we're going to do daily, and then you want to download it to a spreadsheet. You're also going to want to download the returns of the index. For this example, if you're doing Microsoft, you're going to want to do the NASDAQ. If you're doing another company, you might want to do the S&P 500. Maybe you even want to do the Dow Jones, but it's calculated a little bit differently than the other indexes. It's price weighted. So let's go with the NASDAQ here. And the same way, you're going to go to the data, make sure that it's the same time frame. So make sure your start and end dates are the same as what you used with the other asset, Microsoft in our example. Make sure it's also the same granularity, whether it be daily, weekly, or monthly. So I've got a new spreadsheet open here. I'm going to go into the spreadsheets that I just downloaded here. This is Microsoft's 5-year returns. First thing I'm going to do is just capture the date. So I'm going to click on the cell, do Command-Shift down arrow, or I think on a PC it'll be Control-Shift down arrow. Then I'm going to copy it. Then I'm going to go back to my spreadsheet, paste the dates. I'm going to go back. I'm going to grab the adjusted close. This is important. Don't grab the close because that does not account for dividends, stock splits, and it's going to give you a much different calculation. We're going to go ahead and copy that here. We're going to paste it in. And then we're going to go to the index that we use, whether it be the NASDAQ or the S&P 500. For us, it was the S&P 500. So we're going to go ahead and just take that, copy it in here. Make sure you label this. So this is Microsoft. This is the S&P 500. Next thing we're going to want to do is calculate the returns. So we're going to calculate the returns of Microsoft here. We're going to type in equals today's price of Microsoft minus yesterday's. Make sure it is today's and yesterday's there. Might be at the bottom depending on how you've downloaded the data. Divided by yesterday. And there we go. There's the return. Is 0 on the first day. There we go. Now I'm just going to copy that to all the cells here. Then I'm going to do the same for the S&P 500. And actually we can just grab the formula from the other cell. Just going to grab the corner there, drag it into all these cells, and double click, and it should apply to everything. So there we go. Here's our returns. You can turn it into percentages if you want by clicking this. Maybe we want some more decimals. There we go. So the first thing that we're going to do is calculate the beta, but keep in mind it depends on the time frame that you want. I'm going to go to the Excel sheet that I have here. Here you can see that the beta for the different years and different granularities of data is quite different, ranging from closer to 0.5 all the way down to 0.28, which is pretty incredible. On some stocks that have huge events in recent history, the beta could be much different over different time spans. Also, something that we're going to do is calculate the R-squared, which is going to show how accurate our beta calculation is. An R-squared closer to 1 means it's a much more accurate calculation, and down at 0 is really bad. So we found that using the 1 year with the S&P is probably actually the worst way that you could calculate beta for Microsoft. We're just going to pick what makes sense. Maybe you want to do multiple indexes and do what I did. Find the lowest R-squared, and then that's the beta that you're going to want to use for whatever it is you're using the beta for balancing your portfolio. So we're going to go into our sheet here. So the way that you calculate beta is using the covariance of the returns of your asset and the returns of your index divided by the variance of the returns of the index. So we're just going to type equals covar, and then we're going to take the returns of the index, Command-Shift down arrow. Also, be sure to realize that you don't want the last cell because it's going to give you an error. The way that we calculated returns took into account the day before, and if you're at the last day, there is no day before. That's the error. So we're just going to leave that out there. And then we're going to do comma, and we're going to do with the returns of the index, Command-Shift down arrow. Going to close that here. Also make sure to pull that up again. Get rid of that last day. And then we're going to divide it by the variance of that index. And here we go, Command-Shift down, and then we'll just decrement the number by 1 to get rid of that. And boom, there's our beta. We don't want it in a percentage here though. We want a number. There we go. And this is going to give us a beta of 0.93, which is rather close to what Yahoo Finance has at 0.86. But like I said before, our calculations are going to be different if you use a different index. So then we're going to calculate the R squared of Microsoft's returns. And again, make sure to get rid of that last cell there with the R squared of the S&P 500 returns. It's going to be 2. There we go. Our R squared is 0.38, which is rather low, which means it doesn't really approximate the data that well. So we're going to go take the NASDAQ's returns instead. I'm going to go ahead and copy that. We're going to go ahead and insert the copied cells, shift the other cells right, and this is the NASDAQ. Then we're also going to calculate the returns of the NASDAQ by again shifting over the return here and applying it to all the cells below. Just going to double click on this. Boom, there we go. And now we're also going to do the beta calculation with the NASDAQ. So I'm just going to label everything here. This is S&P 500, R squared, beta 5 daily. But now we've got the NASDAQ, so we're going to do that. Going to take the same formula, just going to click on the cell, copy the formula here. Make sure not to copy the cell, just go in to the formula and copy the formula, and then we're going to paste it. Should get the same number, but that's okay because we haven't shifted over. So instead of S&P 500 returns, we're going to use the NASDAQ returns. So you can just grab that little column here and shift it over. You can also just type in the next column number manually and change that back to a number, and there we go. Our beta is 0.86. Now we're going to calculate the R squared value, and again we're going to just copy that here, going to paste that formula in again, and then we're going to move. It's not going to be S&P 500 returns, it's going to be the NASDAQ. And there we go. So our R squared is 0.416, which is higher than the S&P 500, which means the NASDAQ is a better approximation of the data. Here's the beta at 0.86, which, if you remember, exactly matches up with Yahoo Finance's number. This just kind of goes to show that you really don't know what they use. In this case, it turned out that Yahoo Finance is correct, but it's a black box. We have no idea what they tend to use, and maybe your calculations are going to be much better. Maybe you want to calculate the beta over 1 year because something big happened to Microsoft. Maybe you want to do 3 years. Maybe you want to do an entirely different index composed of just the biggest tech companies instead of the NASDAQ itself. So there you have it. I hope this helped you out. If you have any questions, be sure to let us know. Go to quantbros.com. If you have any ideas, any videos you'd like us to make, just shoot us an email and we'll be sure to crank those out for you. And as always, be sure to like and subscribe if you enjoyed the video, and I hope you have a great day.